'Cause I have $30,000 in credit card debt. When they call, I tell them I can't pay it back yet. Credit card debt. Tomorrow I may buy myself a dining room set or this Boba Fett. Credit card debt, credit card debt, credit card debt.
Did you know that 1 in 3 Canadians is so indebted they fear bankruptcy? We'll talk about this and more in our in-depth analysis of personal debt, including a look at past and future interest rates. We're also going to pull back the curtain on Canada's Big Six banks. It's important to understand their role because, believe it or not, a financially illiterate consumer is a bank's best friend. Hi there, and welcome to everything you need to know about government, bank, and personal debt. My name is David Trahair, and I'll be your guide on this eye-opening journey through the complex and often misunderstood world of debt. So, why should you care about debt? Well, because debt is everywhere. In government's coffers, in banks, and likely in your own life. We're living in a time where access to credit is easier than ever, but the knowledge to manage, reduce, and escape debt, not so much. Here's a stat for you. According to TransUnion, one of the credit bureaus in Canada, the average consumer credit debt balance in the second quarter of 2023 was $126,000. That's a lot. So, what's fueling this debt binge? There are a number of factors. Firstly, we'll delve into the psychology of debt, examining why we're so quick to borrow and so slow to pay back. Is it consumerism? Is it need? Or is it simply a lack of financial literacy? Spoiler, it's a combination of all three. And speaking of financial literacy, why isn't it a part of our formal education system? We'll explore the gaps and potential solutions. Next, we'll look at the big picture, fiscal and monetary policy, and the role of institutions like the federal government and the Bank of Canada. 10 secrets to improving your credit score. Practical tips to not just survive but thrive in this credit-driven world. So, whether you're dealing with your own debt or helping someone else, there's a lot here for you.
No one wants to admit that they're in trouble with debt, but we know many Canadians are. The problem is that they are unlikely to discuss it with other people. The absence of candid conversations about our financial experiences hinders our learning process. By not sharing our financial missteps openly, we miss out on a valuable opportunity to learn from other people's mistakes, which is often the most effective way to gain financial wisdom. The problem is, it often ends up costing us a lot of money. I'd like to propose that we try to change the status quo. Let's resolve to encourage people to start talking seriously to other trusted people about their personal financial situations and learn from others. Let's get the ball rolling, shall we? I'm going to tell you a story about my own situation because it has most definitely not been perfect. Sure, it would be easy to pretend I have been a model financial citizen, a beacon of light for everyone to look up to. But that would not be the truth. The fact is, my family's finances are not perfect. I know it's not easy to live in these days of high inflation, especially when it comes to raising kids. It's expensive, but my personal finances are a lot better than they used to be. Here's the story. I was born in 1958, and I'm in my mid-60s now. My wife and I have 2 kids, a daughter aged 26 and a son aged 30. We own a house with a mortgage and have savings in RRSPs, but no savings outside in TFSAs or regular investment accounts. We use 2 main credit cards, one in my name and one in my wife's, and 1 main bank checking account. I also have a separate business credit card that I use exclusively for business purposes. I'm self-employed and I use a corporation for my e-learning content development business. My key objective is to make sure we can afford to pay off our personal credit cards each month. But my finances were not always this organized. In my early years, before marriage and kids, I consistently carried a balance on my personal credit card. Yes, I was a credit card revolver, someone who carries a credit card balance month to month. I didn't really think about it. I was too busy having fun. I didn't even bother to make minimum payments on the card during high spending or low earnings months. For years, I paid thousands and thousands of dollars in interest to my bank. They loved me for it. I was a very good customer. In fact, revolvers are a bank's favorite type of customer. Think of it from their point of view. Say your credit card balance is $10,000 and the annual interest rate is 20%. The bank makes $2,000 per year from you in interest income, a 20% return on the money they loan to you each and every year. How would you like to make a 20% return on your money? You can't get that high a rate consistently anywhere else on earth, no matter what investment strategy you employ. At one point years ago, when I had a tough year financially running a small accounting practice, I was carrying a large 5-figure credit card balance. I'll never forget that period of time. I can remember specifically one day when I was meeting a client for lunch in North Toronto. There was no money in either my personal or business bank accounts. I was maxed out on my business and personal credit cards, as well as my business line of credit. I literally could not afford to pay for lunch. What did I do? I did what most people would do in that situation. I called my friendly bank to see if they would increase my credit limit. The answer was no. I remember that day as if it was yesterday. I sat in my car, put my head back against the headrest, looked up to the ceiling, and said out loud, "What a loser you are." You don't ever forget those moments in your life. But you're then faced with a choice. You can either throw in the towel, or you can make a firm commitment to pivot and ensure such situations never recur. On that day, I made a steadfast decision to never find myself in a similar predicament again. Let's get into why the Canadian consumer debt crisis is so bad. Never before have the alarm bells rung louder about the high debt levels in the world today. There are record levels of debt in many countries, companies, and households. Let's get into the reasons why. The first is human nature. One of the things I've observed over the years is that many people seem almost pre-wired to abuse debt. It's like it's in their DNA. The second reason is we want more stuff. Face it, we all want to live the American dream, right? We want all the things that our neighbors seem to have. The big house, the luxury vehicle, exotic vacations to the far corners of the earth, and the latest tech toys to boot. The problem is that in many cases our earnings are not sufficient to reach this higher standard of living. So what do? We take on debt in order to get what we want. And we keep doing it year after year after year. I once read a great book on personal financial planning. It was 5 words long. Here is the entire book. Spend less than you make. The end. That is the key to a solid financial life, and yet most people have never read that book, or if they have, they ignore its advice. This is a recipe for disaster. But most of us choose not to think of the long-term negatives of a debt-fueled life. Why? Because adjusting our lifestyle to scale back doing and buying the things we want is painful. We avoid the pain at all costs and figure out ways to justify staying with the current lifestyle. Let's talk about good debt versus bad debt for a minute. Good debt is debt used to purchase an asset that will hopefully appreciate or bring in more cash than previously. For example, mortgage debt is often described as good debt because it is used to buy an asset that will likely grow in value. The same could be said for taking out a student loan that results in a higher paying job. Now, obviously there are worse types of debt. For example, credit card spending on big screen TVs that result in bills that we can't pay off and therefore cost us 20% interest or more per year on the balance. Obviously, this is bad debt. The next issue is we want it now. We don't want to wait for our trips and toys, do we? Previous generations were taught that they had to save for the things they wanted. Many of our parents can instantly recite the first thing they really wanted and that they worked, scrimped, and saved for. You've probably heard over and over about that red 2-wheeled bicycle or that first pair of ice skates, right? In the old days, you had to sacrifice before you got things by making money and controlling your spending. For many kids and adults these days, saving is a foreign concept, and the same can be said for sacrificing. They probably roll their eyes when you start a story with, "When I was a kid." The problem is that many people these days are not saving anything. Many are in fact unsaving. That means they are getting further and further into debt by spending more than they make. Now let's talk about the negative power of positive thinking. We humans seem to be very optimistic when it comes to personal finances. We think about the present and ignore what has happened in the past, and don't seem to think too much about what may happen in the future. Housing prices in many areas in Canada have been rising for a long period of time, even since the pandemic began, so we assume they will keep going up. We're earning a good salary now, and we just figure that will continue. Hopefully we'll even be getting raises in the foreseeable future. We loved the historically low interest rates during the pandemic and assumed they would stay low for many years. Positive thinking may be useful in certain situations. For example, a hockey player visualizing hoisting the Stanley Cup just before Game 7 in the finals may provide the incentive to do well on every shift. But when it comes to personal finance, this can often be deadly because it doesn't prepare us for the inevitable financial twists and turns that will come our way. In fact, it can set us up so that the failure is more painful than it otherwise would be. Next is our herd mentality. We humans often seem to go with the flow. Have you ever joined a long line at the airport or at the movie theater before finding out whether it's the right line? Join the club, we all do it. When it comes to debt, this herd mentality often leads us to do things that are just plain dumb. This is especially true when it comes to revolving debt. Let me explain. Revolving debt includes credit cards and lines of credit. It has no fixed terms of repayment like the alternative, which is installment debt. Installment debt includes things like mortgages and car loans that have fixed payments for a specific period of time. The payments include principal and interest. Over the term of the loan, say 25 years for a mortgage or maybe 4 for a car loan, the loan is paid off. Revolving loans never get paid off unless you decide to make it a priority. This is an area that the government has stepped in to regulate when it comes to credit cards. You know that minimum payment amount that credit cards require you to pay? Well, many people only pay that suggested minimum. This keeps their credit score intact, an issue we'll deal with more later, but paying only the minimum will extend the period of the debt. And of course, make more money for your credit card company. This is why the federal government introduced new credit business practice regulations, as well as regulations amending the cost of borrowing in an effort to limit financial institutions' business practices that are deemed not to be beneficial to consumers. To improve consumer understanding of the effect of only making the minimum payments, the government now requires federally regulated institutions to show consumers how long it would take to pay off the balance owing on a credit card if they only make the minimum payments every month. What's the longest you have seen on one of your cards? I can beat that. I once had a personal credit card statement, and under time to pay, it said the following: if you make only the minimum payment each month, we estimate that you will never repay the outstanding balance. No, I'm not kidding. That's because the minimum payment times 12 was less than the annual cost of the card. So not only would the principal balance never be repaid, there would be no interest payments either. This clearly shows the danger of making the minimum payments. You could essentially be in debt forever. Next is the environment. The world around us also contributes to our debt trouble. There are two main issues. The first is that debt is easy to get, so we get it. We are encouraged, through social and commercial media, to take on debt to get the things we want. But isn't the real problem the ease with which we can get other kinds of consumer debt besides mortgages? I'm talking about credit cards and lines of credit here. While it is thankfully tougher to get a credit card today than before the financial crisis of 2008-2009, it is still relatively easy to get a credit card. It's especially easy if you have a good credit score. But having a good credit score does not mean that you are necessarily in good shape when it comes to your ability to handle your debts. Just because a bank gives you a credit card does not mean you can afford it. The credit business practices regulations had to step in here too. Institutions used to be allowed to increase credit limits automatically for good credit risk clients. And last, the recent low interest rates have acted like a drug. To keep the economy going during the pandemic, most nations, including Canada, reduced interest rates to near historical lows. The overnight rate, the rate of interest the Bank of Canada charges on one-day loans to major financial institutions, was reduced to the lowest it's ever been, 0.25% at the end of March 2020, and it remained there until March of 2022. The prime rate that banks use to lend to their best customers usually rises and falls as the overnight rate does. It was reduced to 2.45% at the end of the same month until early 2022 as well. Of course, inflation then reared its ugly head and rates began increasing rapidly. Those several years of low interest rates were extremely dangerous because they encouraged people to load up on debt. And lines of credit were the main instrument allowing people to do so. Don't like paying 20% on a credit card balance that you were carrying? No problem, refinance it with a line of credit at a much lower rate. But there is another reason besides human nature and the environment that encourages abusive credit practices. It's something that nobody ever talks about, but unfortunately it's true. It is this: a financially illiterate consumer is a bank's best customer. There have been many recent studies on the financial literacy of the average Canadian. The results? Many of us are not so literate. The recommendation? More education about personal finances. But there is a major problem with this recommendation. The brutal truth is that a financially illiterate, disorganized client is a bank's most profitable customer. They don't want you to be financially literate. Think about it from a bank's point of view. A client such as this would not worry about paying credit card and other loans on time and would incur interest and penalties as a result. They would probably not bother to shop around for the best interest rates on their loans and simply accept the posted rates. They are less likely to worry too much about increasing debt levels with the resulting increase in interest costs. And they may tend to bounce the odd check and dip into overdraft protection on their bank account, resulting in punitive fees. When it comes to investing, they probably just accept costly bank-issued mutual funds and don't look at cheaper alternatives. All these actions result in profit to the bank. The only catch? They can't go bankrupt because that stops the gravy train of bank profits. Let me tell you a story that illustrates why financial education is not a top priority. Just after my first book, Smoke and Mirrors, Financial Myths That Will Ruin Your Retirement Dreams, was published in 2003, I was very keen to promote it. I actively sought out organizations that I could work with to get the word out about my book and the theories in it. Basically, it dispels many of the retirement myths that I believe are false and misleading, including the idea that we'll need to save millions to retire well, and that piling money into RRSPs and investing in the stock market is the best way to get there. I met a person who worked at a major Canadian university who had read my book and believed wholeheartedly in its theories. She loved the free spreadsheets that come with it. I volunteered to put on as many free seminars as there was demand for. The idea was to reach students, teachers, and alumni. It was an exciting time. The potential to market my book and reach people at a young age was enticing. I spent a lot of time thinking about and creating the presentation. I was psyched, and then about 2 weeks before the first seminar, it all fell apart. She called me and told me all the seminars were canceled outright. What do you think happened? Why would a university cancel free, unbiased financial education for their students, staff, and alumni? Because the financial partner of the university got wind of the seminars and said something to the effect that they didn't want that guy spreading his message. Why? Because it would be bad for their business. They did not want anybody warning their clients and potential clients about the dangers of carrying credit card debt, one of their most profitable products, or making it clear that many people do not need millions of dollars to retire comfortably. That is just sad. I lost a lot of respect for that university as a result. But think about it for a minute. If all Canadians diligently tracked their finances, never spent more than they made, never carried a credit card balance, didn't take out a line of credit, and made sure the only debt they ever had was good debt, like a reasonable mortgage that they paid off early, the economy would crash. There would be much lower bank profits. There would therefore be no large corporate tax amounts flowing to the government. There would be much less personal income taxes to the government on the six-figure salaries of the bank's employees. So it seems even the government benefits from a less financially educated population. So who is going to educate you about your personal finances? You are. And you've just taken the first step.